Ladies and gentlemen, good day and welcome to Mallcom India Limited earnings conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital. Thank you, and over to you, sir.
Thank you, Archie. Good afternoon and very warm welcome to everyone. On behalf of PhillipCapital, I am pleased to welcome you all on the earnings call of Mallcom India. We are happy to have the management with us here today for question and answer session with the investment community. The management is represented by Mr. Rohit Mal, Associate Vice President, and Shyam Sundar Agarwal, Chief Financial Officer. Before we start with the call, we will have opening comments from the management. And I now hand over call to Mr. Rohit. Over to you, sir.
Thank you, Vikram. Good afternoon, everyone. It's a pleasure to welcome you all to our earnings conference call for the first quarter of financial year 25-26. I'd like to begin by extending our sincere thanks to PhillipCapital for hosting today's call. Let me start by sharing a few operational highlights for the quarter under review before handing it over to our CFO, Mr. Shyam Agarwal, who will take you through the detailed financial performance. Let me begin with the CAPEX update. The trial runs at our newly set up Protech unit at Sanand, Gujarat has been successfully completed, and the unit commenced commercial operations effective 1st July 2025. We have spent 95 crores for phase 1 of the project, and we expect a turnover of around 10 to 15 crore from this unit in the current financial year. We also plan to slowly increase the production capacity of synthetic gloves and helmets at this unit. For that, we have planned an additional capex of up to 10 CR this year, mainly towards importing more lines and machines. The second phase of expansion of our Chandipur unit is largely complete. This phase involves setting up a new facility for designing and manufacturing of industrial safety shoes with a built-up area of almost 70,000 square feet and a capex of 25 crores. The unit is now operational, and we expect it to generate a turnover of about 25 to 30 crores in the current financial year. Further consolidation work is planned during the current quarter. I'm also happy to share that Mallcom received the Silver Category Award in the Eastern region among 2-star export houses from FIO for the financial year 2021. This recognition reflects our continued commitment to export excellence. We have also established an office in the UAE to strengthen our presence in the Middle East and Africa region, which we see as a high potential branded export market. With that, I'll now hand over to Mr. Shyam Agarwal, our CFO, who will walk us through the detailed financial performance of the company.
Thank you, Rohit, and good afternoon, everyone. I would like to provide an overview of the financial performance of the first quarter of the financial year 25-26. On a consolidated basis for the first quarter, the operating revenue stood at rupees 122 CR, reflecting a growth of 19.5% year-on-year. EBITDA for the quarter was 18 crores, up by 23.1% year-on-year, with EBITDA margins at 14.38%. The net profit was reported at rupees 10 CR, with PAT margin at 8.09%. The increase in EBITDA margin on a year-on-year basis from 13.96% to 14.3% was mainly attributable to a reduction in our manufacturing operation and other expenses. Thank you. With this, we can now begin the question and answer session.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mr. Aditya from Securities Investment Management. Please go ahead, sir.
Yeah. Hi, sir. Thanks for the opportunity. So firstly, just wanted to understand, we did a revenue of around 190 to 195 crores in shoes last year. So was it primarily for domestic markets?
Yeah, that's correct. Largely for domestic market. Major share is going to the domestic market, and then, but we are also exporting, lesser percentage, but yes, we are also exporting.
Understood. So, sir, then when I look at the total domestic revenue, which was around 200 crores, so are we primarily a shoe brand in India, and we are not able to supply other products in the domestic markets?
Large contribution of the domestic revenue is contributed from shoe. I wouldn't say that we are not able to supply other products. We are supplying other products, but you have to also realize that shoe as a category has a higher average revenue per unit than other categories as well. So volume-wise, maybe a mix will be a little different, but revenue-wise, yes, large contribution to the branded or domestic revenue is contributed through shoes. But we are also supplying other categories like head protection, gloves, workwear in the domestic market.
So, Rohit, just to clarify, I would like to mention that Indian market traditionally has been, the first in the category of safety products, industrial safety products. It picked up the safety shoes as the most preferred product, and so this was the segment which grew faster. And now the market has started accepting the other category. Helmet was always there where we are not earlier present, but now we are trying hard and we are capturing some market share there. But the hand safety and body safety is something which still needs to be developed, but it has started developing, and we are there. So this segment of this segment is also started growing now, yeah, and we are there.
Understood, sir. And I think in the previous calls you mentioned that domestic would be one of the major drivers for our growth in the next 3 to 4 years. So just wanted to understand the reasons for the same. So is it better distribution reach for us, or supplying different products other than shoes? If you just elaborate, what would lead to higher growth in domestic markets going forward?
So there are some internal reasons and some external reasons. So external reasons, there are a lot of tailwinds in this industry. You have more, better policies from the government for occupational safety and health. You have companies who are becoming more stringent about their requirement. You have MNCs who are, asking for such products. And then internally, we are expanding into different product categories. In the same product categories, we are launching different products. We are emphasizing more on our supply chain and ensuring deliveries are happening within time and to all places within the country, and now also exporting to Middle East, Africa. We are strengthening our distribution channel as well as our sales channel to ensure, that we are keeping up and increasing the rate of growth of the revenue from this market. So these are some of the reasons which is helping us keep up with the growth.
Understood.
Sir, could you come again? There was a static disturbance. Hello? Yes, sir. Sir, there's still disturbance at your end. You are not audible, sir. Maybe, sir, you could rejoin the queue because we do have participants in the line. All right. We'll move on to the next participant. The next question is from the line of Mr. Rushabh Shah from Burgle Rock PMS. Please go ahead, sir.
Yeah, thanks for the opportunity. So I had two questions. So since you said you are expanding your distribution reach and your business is based on completely on distributors, so how many distributors have you added in the past 2 to 3 years? And sir, when times are tough, how do you take care of the distributors?
The exact numbers, I will not have it ready at this moment, but I'm sure we've added at least 8 to 10 or maybe more distributors in the last, 2 years. So for us, might be...
Sorry to interrupt. These distributors you added in the domestic market?
Yes. Domestic as well as international markets. So, Middle East, Southeast Asia, Africa, all these places we've added. And so these are the registered distributors, but then there are also a lot of, people who we are distributing to, but they're not registered because we have a criteria to making them a distributor. We just don't make a distributor at the first go. So unless the criteria is met, we don't make the distributor. And secondly, if your question is when the markets are not good and how we managing our distributors and how we're doing it. So see, we have been in this business for a long time. Our distributors know what kind of products we deal in, what are our, payment terms, what is the quality of the product. So the brand is being built in the industry because of whatever we have been doing in the past. So we do support them when time comes and when the market is not so good. But as of now, what we're looking as of right now in the last couple of years or, going ahead, we see there's a lot of opportunity in the market. We don't see a slow, at least for our products, because it is going into various industries. But when time comes, we support our distributors, and that's why some of our distributors have been associated with us for more than 10 or 12 years.
Okay. No, I was not asking about the market slowdown. I'm asking how, like you said, you support your distributor. So what do you do to support your distributor?
You have to be more specific. I did not then understand the question completely.
No, sir. In terms of, let's say, distributors having some problems, so how do you help them out?
No, there is a marketing support which we provide to them, and maybe some credit also we provide sometimes. So it depends. So Rohit, you can explain on this.
Yeah, so we have a sales team, which is there on ground near the distributors, also who's visiting them, interacting with them on a regular basis. There's a customer support team which is assisting them. There's a finance team which is assisting them for payments or credits. There's escalation matrix which we have in place, which they can reach out to if they want redressal of some problems or any support from us. If they want us to visit to a customer together, we shall be available with them. We support them with marketing materials, with branding materials, with passing on the leads. So these are the various kinds of support we provide to our distributors.
Fine. So my second question is, I wanted to know, sir, how difficult is it to get approval for our safety products in Europe, and especially which country is it most difficult to get?
So European Union works as a whole. It's not country specific. But there are EN standards which you have to get your products approved by, and for you to sell into Europe. And the EN standards also depend. Some are, some standards can be met easily, and there are various levels in the standard also, level 1, level 2, level 3, things like that. So it depends on which testing you're talking about, which product category, what is the kind of risk or hazard associated with it. That will define the complexity of getting the certification for it. And since we've been in the business for a long time, so we have a lot of certification across our product categories, and some have basic certification, some have more, complicated certifications, let's say.
And my last question is on the tariff part, sir. How our products would be affected?
Tariffs into the US, as we all know, it's very fresh. So even our products are in something that will be affected, impacted. But we'll have to wait and watch. Our exposure to the US is not as high as maybe some of our other, competitors. We are more exposed in the European market than the American market. But largely all these products are produced in Asia. So we have to see how we, place against our competition from Asia. But yeah, all our products have been impacted by the tariffs. So we'll have to wait and watch if both the countries sign some sort of a trade deal.
Fine, sir. Thank you.
Thank you. The next question is from the line of Mr. Sukrit Patil from Eyesight Fintrade Private Limited. Please go ahead, sir.
Good afternoon to the Mallcom team, and I would like to congratulate you that on the past 2 years you have made good wealth on the shareholders' behalf also. So my question is, I have a long-term question, is that with Mallcom's global footprint across 50 countries and rising demand for ESG compliant PPE, how is Mallcom integrating sustainability, circular design, or material innovation into your product roadmap? And could this become a differentiator for premium global contracts for the FY 2029-30? I would like to hear your thoughts, and can you please share a view on this? Thank you very much.
Yeah, that's a great question and something that we are dealing with right now. So we are already on the path for this. So there are various aspects to, becoming ESG compliant. So one is you have the ESG compliant facilities, and then in the products, what are you doing in the final product sustainable? So some of our facilities, and the endeavor is all of our facilities at some point become, ESG compliant. So which is in terms of having renewable energy. We do have solar panels for our leather production. The entire heat generated currently for our dipping gloves facility is through biomass, and that is where we, take care of circular economy also, because this biomass is, generated from rice husk, which is abundantly available in West Bengal. And then this rice, then the ash that is created, that is also converted into fly bricks. So it is completely circular and completely renewable energy that we are creating, and we save a lot of CO2 and SO2 emissions because of that. In terms of the product itself, we are using a lot of recycled materials, be it polymers, be it polyesters. We are using recycled materials in all these places. We are even trying with chemicals, how can we put more and more recycled materials without losing the sanctity of the material and without failing the test that is required. So the efforts are going towards that as well. Now, in Europe, a lot of people have started using digital passports for products, where they're measuring, okay, each product contributes how much to the carbon emission. So we are being asked a lot of these questions, where we are also trying to find solutions for. And a lot of our customers have been happy with our products, and earlier where they were manufacturing, now when they shifted to us, they have been able to improve the carbon footprint per product, and that's the data they give us, and they also evaluate us on a regular basis based on how much energy we are emitting, what kind of work we are doing for our compliance, how we taking care of our people and the environment nearby. So going ahead, definitely it will be a big advantage for companies who can do it, because the market, especially the European market and the Australian market, some more advanced markets are heading towards such practices, and this will become very much like a mandatory thing by maybe FY 29-30. And we are geared up for that, and as a company, as our values stand also, we want to head towards that direction, be it with the product, be it with the facility, be it even with packaging solutions or logistic solutions. We want to head in that direction.
Yeah, I think that pretty much answers my question. Thank you very much, and best of luck for all your future endeavors.
Thank you. The next question is from the line of Mr. Ritvik Sheth from One Up Financial Consultants Private Limited. Please go ahead, sir.
Yeah. Hi, good afternoon, sir. So a couple of questions from my end. So firstly, what kind of growth do you expect for FY26 and 27?
So going ahead, we would like to maintain similar or higher growth rate in the range of 20-25%. That is what we have been targeting and trying to target if we want to meet our overall growth. So that's a number we are still going to stick by, and let's see how well we are able to perform.
Sure. And this will be despite the US tariffs, because assuming that it goes on for some time, the sales would be lower. So this would be despite the US tariffs.
Yeah, see, a couple of points on that. One is our exposure to the US is limited. It's not a major market for us. We were definitely planning to make it a major market. There was a lot of push and expectations on the market, but right now it's still not a major market. We will continue to put our efforts because we feel that this is temporary and you never know what's going to happen. Secondly, when one market closes, there are other market which opens up. So now we have a free trade with UK. Hopefully we'll have some deal with Europe also signed up. The domestic market, the Middle East market, these markets are still growing. So there are other avenues also, and we feel even with the US, this is not something which they can sustain because a lot of products what we make, nobody in the US is making it. It's all being done in Asia, and we've seen after COVID, everybody wants double supply chain at least. So I don't expect the entire business to get disrupted because of this. There might be some hindrances to it, but I think if we are able to stay in the business for long enough, we'll be able to see positives from it. So whatever this situation is, I think it is temporary, and it does not change our growth plans.
Sure. That is encouraging, sir. So secondly, on the margins, Q1 margins were very good, around 14.5%. So could this be a new normal going forward?
Shyamji?
Yes, so as we have been mentioning this, the margin should be in the range of this 14% around this figure only. And in the quarter, we have definitely saved on, some few expenditures we were doing in the past, like last year we did some consultancy expenditure, which was a major one for us, almost 1% of the turnover. So that we have started saving this year. And then, some other expenses also are there, which we are trying to save. So going forward, we see that this, margin should be maintained in the range only, right?
Sure. And just one last question. So the Sanand facility, you mentioned that 15 crores would be possible from this unit in FY26. So we are, I think we are under the understanding that we can do approximately 100 crores from this unit with current capacity. So why is that a lower guidance given by you, or 15% utilization will be there for 9 months for this year and then it will ramp up next year?
No. So Rohit, let me answer this. So no, it is not like this. So what we have done that, as we mentioned in the past calls also, that this was more of infrastructure creation where we have invested into land and building, and we have set up the minimum basic line of masonry. So now we have planned, as Rohit mentioned, that now we have planned to set up more line of masonry. So till now it was, infra creation with basic machinery setup is there. We have done trial run. We have started commercial production. But again, we have to increase the machinery. So that's why with the current setup, we have given this projection of 15 CR around, in the range of 15 CR we will be doing during the next half year. But in the process, we will be in the process of setting up new machineries also. And once this setup is there, then we should be reaching targeted turnover of 100 crore. So at full capacity, not this year, next year, FY27, definitely we should have a better turnover. Not if not it is 100 CR, near to 100 CR, or maybe around that figure only.
Okay, so we have spent close to 90 crores, and another 10 crores we will spend in this year, and then our total revenue can be around 100 crores at peak. That
yes. With that investment, because as of now it is more of infrastructure and basic machinery setup there. Yeah.
Okay, sir. All the best and thank you.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Aditya from Securities Investment Management. Please go ahead, sir.
Yeah, I hope I'm audible.
Yes.
Sir, in the domestic markets, generally, what kind of customers and products would MNCs like 3M and Honeywell would be having, and what kind of customer base would we be having?
So in terms of the product category, 3M and Honeywell operate in a little different product category. For example, 3M is largely above the neck, which is head protection, ear protection, eye protection, face protection. They do largely that, and that's a very small category for us at this moment. And Honeywell does overall, except garments, and largely they do a global operation, not something specific for India for both these companies. And they're fairly highly priced for the Indian market because they have those kind of cost structures and those kind of brand. So wherever you will see a global RFQ or a global tender, you will see maybe Honeywell or a 3M, or wherever it is a very specialized kind of work which somebody like a 3M will only provide, and you'll hardly have one or two competitors in India, then you'll see 3M. And in other cases where if there is unavailability of product, then you will see Honeywell and 3M. For example, we'll compete with Honeywell in synthetic gloves also, we'll compete with them in head protection also, etc. So in Indian market, they're fairly highly priced and largely concentrating on bigger MNCs and brands. And for us, we cater to the mass market as well as the premium also. And largely we are into foot and hand and body protection, which they don't operate largely into.
Understood. So just, wanted to get a better understanding. So in the domestic markets, why would a customer prefer a Mallcom product over a Liberty or a Bata kind of a product? So just wanted to understand what is the customer looking for, what are the factors he's looking at before deciding on which brand to go for?
Various factors they look into. They look into the product quality and if it meets the basic requirement, the BIS standards, for example, or if they have some additional requirements they look into it. B, they look into the pricing of the product. C, they look into the delivery. Fast can they get their product? Then they look into the service levels, what is the after sale service, if the final, seller to them provides some credit or not, those kind of financial considerations they'll also have. Largely these are the 3-4 things that they look for. And finally, depends on the size of the company. They would not like to have a lot of vendors for these kind of products. They would like to have one vendor for all their MRO items. So they'll also like to see what all do their vendors carry, what all kind of products, and if they can have one vendor providing all the solution, they would like to stick to that vendor because they're already registered and empaneled with them. So these are some of the factors which help them take the decision.
Understood. And also, last year we had hired a consulting company. So just wanted to understand what were the key learnings from it, and how are we going to implement the learnings? So if we just talk about it a little bit more, that would be helpful.
Yeah. So the company that we had hired was not just giving us the, let's say, the solution. They were part of the implementation also. So whatever was to be done was already implemented last year. They had come largely for increasing our operational efficiencies in our factory. So setting up processes, creating more, being able to do more from the same resources, how to channel it properly, how to deliver faster, how to be more sure of the lead times. So it was essentially to solidify our supply chain of our products from our vendors to our customers, and how can we, do it faster, better, more efficiently. And that is what they were able to deliver, which gave us some positive results, and which the results are already reflected in the financials, as well as going to market strategy that we are having.
Understood. So just wanted to understand, so its impact on financials. So should one see a lower working capital or a higher margin or a higher growth? How should one interpret whatever we are implementing? How should that be getting reflected in the financials?
Right. So they did for a couple of units, not the entire organization. So you will not see as an organization as a whole, what will be the impact. But for that particular category those particular units, we have seen improvements in, our revenue, our capacity utilization, our efficiencies, our lead times and the delays that we had that some customers were experiencing. So that is where we have been seeing improvements. So on a global company level, that would not mean a humongous change, but on a unit level, on the product category level, we have definitely seen benefits.
Okay. And sir, now if I exclude this new facilities which we have commissioned in Sanand and Ghatakpur phase 2, the existing facilities, what kind of revenue potential can we reach over there?
Shyamji, if you can.
Yeah, so as we mentioned from the Sanand, we expect with the full, installation of all the machinery which we have planned, we should be getting over during this FY 26. We should be having additional turnover of around 100 crore. And from this phase 1, which we have set up in Sanand. And the second phase, Ghatakpur unit in West Bengal for SU, we are projecting around 50 crore turnover on full year basis from SU unit. Additional turnover.
No. So my question was excluding both these units, the existing facilities, what kind of revenue can we reach over there?
From the existing units?
Yes.
So this is what we are doing. So we are in the range of around 500 CR we have already done. So, that is always there, and there also we can have additional turnover from the existing setup by going for additional shift, maybe some job working we can get done from the associate or, satellite units. So that is also possible. So 500 CR we are already doing, and maybe more 200 CR is additional is possible from the existing facility only. We keep adding, additional machinery there, like knitting, stitching machines if we need at our garment facility. So we have enough floor area, and need-based we can set up it on very short notice. Same with the shoe upper or maybe the leather gloves units also. So it is scalable. So anything in the range of 500 CR to 700 CR we can do from the existing facility with some further, small capex that, and this apart from this new setup which we have done.
Understood. And now, for this 100 crores which we are expecting from Sanand phase 1, so this is only going to come from Protect, not the helmets and the synthetic gloves, right?
No, both. The entire thing, there would be Protect as well as helmets also.
Okay, understood. So next was on exports. So generally, what kind of visibility do we have? So in terms whether the customer gives us an order book, of 2-3 months. So how does the export revenue generally work?
It depends from product to product, customer to customer. Some customers we have annual projections or rolling forecasts from them, and then they give us orders based on our deliveries. And with some customers it's order to order. We know the cycles when they'll place orders, or we know the volumes that they'll have. And for some of them it is some one-off that we are selling to them. So it depends. Usually we try to keep an order book of at least 2.5 to 3.5 months, and we work on that basis.
Understood. And generally, how much of our revenues would be contracted versus spot?
I'm really sorry to interrupt.
Yeah.
We do have other participants in line too. Could you please rejoin the queue, please?
Sure.
Thank you. The next question is from the line of Mr. Nikhil Upadhyay from Simple. Please go ahead, sir.
Yeah, hi. Good afternoon. Congrats on good numbers. Just continuing with what the previous participant was asking, how would the revenue mix be between contracted versus spot kind of orders for us?
No, so everything that we manufacture, we do on our own. Contracting will only be some stitching operations. Even in that, we are usually, giving the cut components, the fabric and everything, and the finishing is happening in-house. That will be a very small proportion of the entire, volume.
Sorry, sir. I was not asking from what we contract out. I was trying to understand in terms of our order visibility, how much of our orders would be contracted orders for a year, and how much would be spot for exports?
Okay. So largely, I would say almost exports 60% will be contracted, and 40% will be spot orders. But this is average. It depends on category to category.
Got it.
Category to category.
And in the starting of the call, you mentioned, and one of the questions was that what is giving you the confidence on the domestic market? And you highlighted few points in terms of increased protection becoming an important part of manufacturing and all. If we have to look at your customer addition, are these customers who are first time buyers, or are these converters who were earlier buying from some run-of-the-mill kind of products and are now moving towards a brand like Mallcom? How would you say the new customers are?
I would say both kinds. We haven't done a deep dive analysis on this, but I would say all two kinds plus one, in the sense there are new customers getting added. So, people who are having, very small units, 5, 10, 20, 50 people, they are also placing orders with us. And sometimes for dealers, sometimes even through e-commerce marketplaces, etc. And then there are some which are because they don't want to get into the hassle of, not meeting the specification, or, some injuries happening and them facing some penalties. So they would like to have a proper BIS certified product. So those kind of, people are also converting And in some cases, even the workers or the employees are getting more vigilant. They are more aware about the products and the certification, and they would like to demand something which is suitable for their risk and hazard. And then there are other kinds where they're already buying from a different brand and they would like to switch to a brand because of various reasons which I mentioned in the past. So I would say all three kinds are there who we are adding to our kitty, because in general the market is growing, right? We are adding a lot of new workforce, a lot of new manufacturing is coming into the country. So the pie is becoming larger. So I think we are adding all three kinds of customers.
Okay, just last two questions. One is on this custom. As you said, now companies, even smaller units, have become vigilant on the kind of products. So has the market moved away from pure pricing-based decisions? Like because there are many smaller unorganized players also who are providing these protective products. So have the units or the manufacturers moving away from only pricing-based decisions and more on product quality-based decisions?
Yeah, a lot of that shift is happening. It's not entirely price. It is definitely a factor, but not the only factor in a lot of cases. So the market is evolving with time. Correct.
Okay. And last question. See, we added these two capacities in Sanand and Ghatakpur, and as we said, they are in a ramping up phase. If you have to understand what would be the one is, are they breaking even at current utilization? And if not, what is the kind of drag they are having on our profitability?
So, Rohit, let me answer this. So, see, this Ghatakpur unit which we have set up in West Bengal, it is, the capacity utilization here would be almost 100%. So, as I said that with this unit we expect 50 CR turnover. And so we have started with this now. So current year projection is around 25 CR for next 6 months, and full year basis would be 50 crores. So with the 25 CR capex, 50 crore turnover we are doing, which is quite reasonable. In case of Sanand, as we mentioned in the past also, that this is more of infrastructure creation. A lot of things are possible there, which we are planning to do. We started with this protect wear and helmet project, and we are in the process of ramping up the capacity, and the full project is yet to come. That it is a big space, and we still can build up an additional building of around 1 lakh to 1,50,000 square feet. So second phase is yet to come. So we have to look at this project as the one complete project maybe will be over need-based and in the time to come. But with the 100 CR, definitely we would be, not immediately. There is no chance of breaking even with the 15 crores turnover. But we'll try to do this from next year onwards by FY27.
Okay, so there is some drag because of Sanand, but Ghatakpur is already contributing.
But again, just to clarify that Sanand is definitely fully invested by us, internal accruals only. We have not borrowed anything. So, and the fixed cost there also is not very high. So, it would be not that big drag, minor only.
Okay, okay, fine. Fine. Thanks a lot. I'll come back.
Thank you. The next question is from the line of Mr. Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Rohit and sir. So, sir, my first question is, for Sanand facility, we sounded quite optimistic about, going to 100 crore and beyond next year in FY27. So, that's a sharp increase from 15 crore number. And even at a company scale of 500 odd crore, that's a very significant number. So what gives us that confidence? Is it that, we have soft commitment from our clients, or is it the overall market buoyancy or the new product introduction? What is driving your confidence that next year will be close to 100 crore in Sanand?
So first part, Rohit, let me explain how we are going to achieve that. So suppose we have started with one set of machines, so it will be triple or fourth, so maybe 4 more lines we set up with the additional 10 CRs investment. So that makes us ready for the 100 crore targeted turnover. The second thing is marketing, which Rohit can explain how we are going to achieve that.
Yeah. So it's in a combination of different things. So one is we are adding a new product category, and two is we are substituting imports also, something that we are for the local market we are trading right now, but we plan to manufacture that. So we know the market, we know the potential of the market, and we know that once we are able to manufacture, we'll be able to control more costs in it. So we'll be able to increase our offerings to the market also. That's there. We are planning to do helmets there also, which, as you know, is a relatively new category for us, and we see a lot of potential in that category also. So increasing capacity, adding new products, and outside India and within India is, making us believe that, okay, it can be done faster, and even the supply chain and the faster access to the market. So largely the Western India, the Southern India, and even Middle East and Africa, it can be much faster catered from a facility in the West than a facility in the East. So I think all of these reasons combined give us that kind of confidence.
Another thing, Rohit, you mentioned that typically large companies would want vendors who have a complete product suite. And, in terms of, product suite, I think one white space we had was the head protection, which we are now filling. So do you think at any point in time, either for domestic or export market, that was acting as a constraint for us, which, now will get solved, and hence probably will, we can do much better in terms of penetrating client and getting higher wallet share?
Yeah, in some industries, with some companies, we definitely felt that, something like a construction or mining where helmet is almost a mandatory thing. So we were definitely losing out on those industries because we didn't have the right product. And now that we have, we will able to give them an entire solution. So definitely that will play a factor, and that has been playing a factor for some time now.
Okay, got it. And last question, Shyamji, generally what we have seen in most of the companies is that as scale increases, revenue increases, operating leverage plays through. But we are saying that our margin will remain largely 14-15% range. So not able to understand whether we will keep on investing through P&L to grow revenue. That is how we should look at it. Or are we saying that for scale, we will probably work at slightly lower margin at a gross margin level, and hence the margin will remain same? If you can decipher this thing for us.
See, I tell you, in our type of industry and industry, you will see that, the PP industrial safety product which we are manufacturing, the fixed cost has always been on the lower side, So it is most of, raw material cost and the other operating costs. So that this is what, makes us believe that going forward also, the scale of the, economy, that might be there, but not that, I would say not that important, because we know that, yes, we have invested, and these are all bigger facilities now, but we are keeping control on fixed cost there, and therefore the margin should be in the range only.
Thank you. That's it on my side. Wish you all the best.
Thank you. The next question is from the line of Mr. Varenya Agarwal. Before we take this question, participants, if you want to ask any questions, you may press star and 1 on your touchtone telephone. All right. The next question is from the line of Mr. Varenya Agarwal from Inflow Associates LLP. Please go ahead.
Hello.
Yes, sir. Please go ahead.
Hello. Hello, can you hear me? Hi.
Yes, sir. We can hear
Hi.
you.
Yeah, thank you for taking my question. I had one question. I was checking out your cash flow statements across the years, and I see that, our cash conversion cycle used to be around 100 days, maybe 10 years back, 190, 100, around that. And now it has suddenly, in the past few years, I see it has gone up to 150, 170, stuff like that. So can you please comment on what has changed, both in terms of receivables, how we are handling it, what has gone bad?
See, basically, it is a need of the industry. So, with the growth in turnover and going to the, the newer markets, like we started selling into South American countries or going to America also. So Europe was always nearer, and we used to had some, maybe CAD or maybe, shorter payment terms. But now with the going to South American markets, they would like to pay only once the cargo reaches there. So maybe 60 to 90 days credit they are looking for. So in certain increase in debtors also, and apart from that, the inventory also, the type of inventory which we need, some of these are also, imported from overseas. So you need to keep the inventory to ensure that you are able to make the goods in timely manner and supply to the customers all the time. So that is very important for our type of business. These are customers are more looking for timely supply, and until unless you keep the stock ready for them and based on their requirement, you are able to supply. So that is very important. Recently, as we mentioned that we had appointed consultants. They also recommended that you need to keep some inventory. So as you will see that it is mostly consistent of raw material. So hardly anything with the WIP or the finished goods. So that is But again, we are aware of this, and we are trying to reduce some of the inventory, which is target for the year. So let us see how it goes.
So, sir, going forward, should we expect a similar kind of working capital cycle, or do you plan on reducing it?
See, with the growth target in the mind, we have to keep the inventory. So it should be in the similar range, maybe a little bit on the lower side, but that would be our effort. But otherwise, we need, that is, the primary target is that we should have growth and targeted turnover. And for that, if we need to keep some additional inventory, we will keep continuing that.
Okay. And one last question. Except for 3M and Honeywell, who do you consider to be your biggest competitor, maybe domestically or even outside India?
Right.
So it depends on the product category. So, for example, for shoes, even Bata and Liberty are good competition. And for gloves, there's Ansel also. For helmets, there's Karam. So it depends on the product category. Internationally, a lot of competition comes from China, Pakistan, and other places also. Not necessarily they are large names. There might be Midas and even Ansel and even Honeywell in international markets become sometimes our competition. But a lot of it is coming from China, and we wouldn't know proper names also. Who are those? Who are our competition in the international markets?
So in terms of pricing, would you say that you are equivalent to these guys, or they are like you're cheaper or more expensive than them?
In India, we are competitive when it comes to pricing with these kind of brands. And when obviously because a large portion of the market is still unorganized, so with that we are not in that price range. Internationally, depends on the product category. Some product categories from China or Vietnam, Pakistan are much cheaper than what we can offer. And in some of the categories in which we operate, we are price competitive. But then there's a question of the quality also, which comes to play. Largely in the categories we operate, we are competitive, and that's why we've been able to stay in the market. But yeah, there are definitely some categories where completely off the money, and some qualities that we don't produce and the prices we can't offer.
So would you say this is a price-sensitive market outside India? I mean, assuming that it is organized outside India.
Yes, some of the categories are very price sensitive. Basic leather gloves are very price sensitive. Very basic level of garments is price sensitive. So some of these products are price sensitive.
Okay. Thank you so much.
Thank you. As there are no further questions from the participants, I would now like to hand over the conference to the management for the closing comments. Please go ahead, sir.
Thank you all for participating in the earnings conference call. I hope we were able to answer your questions satisfactorily and at the same time offer insights into our business. If you have any further questions or would like to know more about the company, please reach out to our investor relations managers at Valorum Advisors. Thank you and wishing you all a great day ahead.
Thank you, sir. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming con calls.